Right. Hi, Amanda. Great. So this is the first question you did, question 160. So let's look at it. This is the question over here. This organization called Sunflower, with a number of predominantly non-current asset risks and well, asset risks really. Some business on their refurbishing of some of their supermarkets, their inventory, and some control issues in terms of actually the financial records. So before we look at the answers, I'll go through your work. And so it says here, list 5 sources of information that can be used to gain an understanding. So very much a knowledge question, very much a knowledge question. So let's look at your material and what's happened here. I've marked this. So typically, I guess it's a kind of internal, external approach. Let's get as much as we can internally from within the organization. So everything we can lay our hands on. So audit files from the previous year, management accounts, if you like, on previous events and any forecasts, financial statements from the previous year. And then when we talk about the external, we're really looking, if you like, at a kind of almost what's happening around this organization, almost what's referred to as a Porter's five forces, but I'm just exaggerating. I'm just kind of throwing in some extra terms. Really, you've done well. I mean, I've given you the full marks there. So typically, Porter really says that there you are. Who's your competition? What are your who are your customers? Who are your suppliers? If you like, in terms of your power of your customers, power of your suppliers, just really looking, just searching online, if you like, as to what's actually going on. What are if you like, what are the substitutes, and what are the threats? I'm sorry, what are the complements in this organization? But the key point really is that we're looking internally and externally, and everything you've written here, the company website, searching for competitors, inquiring of management, if you like, management minutes, whatever it is. You've written all the very strong ones. So you have all the marks there. Great. So let's now carry on. The next question wanted you to, says, using the information provided, describe 5 audit risks. And so you have sorry, actually, let me go to the answers to just see what they had for question 1. So for question 1, they had the prior year audit file, which we mentioned, the prior year financial statements, which you mentioned, the current year budget and management accounts, which you mentioned. Let's see if forecast drops in next. So there wasn't a talk of forecast. The permanent audit file, the website, prior year report to management, that was good. Financial statements of competitors, which we take off Companies House, which you mentioned. And let's see, there was also, whoops, sorry. What else what was there? There was this business here of the current year discussion with management. So those and accounting system notes. So as you've done this now, you seem to have the other ones logged in. You can just add this to your log, of your memory log, as to what's going on with preconditions. Preconditions. Okay, great. Sorry, to do with understanding the entity. Right. Let's look at the next question. The next question asks you to look at some risks. Always the big one. So we're really using a tabular format, which you did very nicely. And let's go through your risks. So what do we have here? So I have put here, I'm just going to change my pen. This is black. What is this? This is black or gray. So Sunflower 1.6 on this. So I just put here, you've put there's a risk that the asset may be misstated. Not a problem. Just we can actually be very clear as to what type of misstatement. So we're really saying that the assets, I put good, we're saying the assets the risk here is the assets are overstated. I mean, it's just a risk. It's possible that they might not have included all the relevant expenditure for capital, but then you know exactly what you're talking about because you say here, if revenue expenditure has been treated as capital expenditure, then we're really then talking about the risk of overstatement. But that's really by the way. And then this is an extension if you wish to talk about expenses therefore being understated and therefore being, so this is chain reasoning with this, but this language of overstatement and understatement you talk about here straight away. And if you like, what is your response? Your first response always is to obtain a breakdown of all the expenditure. and then go through yourself with all the backing documentation. So you've written review the relevant expenditure. So I mean, again, I think as we go down, I kind of highlight the AEIOU principle here. This is the language they like. I mean, it doesn't really matter. Review. I haven't checked the answers actually to see if review is still fine. But we want to the closer you are to inspect. The better. So AEIOU, analyze, inquire, inspect, observe, and the U, of course, recalculate, reperform, blah, blah. So that's fine. Yes, of course, you want to go through that list to be sure that everything there is truly capital and truly expenses. And that's the first thing. Capital expenditure has been added to the fixed asset. Yes, and revenue deducted. Exactly. So I think I gave you 1 out of 2, but I think I'm going to give you one here as well. So it's a mark for each. Yeah, for this one. 1-1. Great. Then let's move on to the next one. La, 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 la. The central warehouse has been expanded and the smaller warehouse sold at a profit. So a couple of risks here that you highlight the very good one here, that this warehouse is still the old warehouse, the one that's been sold is still on the fixed asset register. Therefore, very good. Overstating assets. Brill. Um, and which you highlight here. And then, of course, this is really a carry-on. This actually the central warehouse. Let me just see how that was expanded. So we're really talking here about. Let me just sort of pick that up. Um, sorry. Yes, right, of course. So that kind of comes, so you're really only focusing on this one, right? Of course. So really this expansion really was to do with the fact that we might have recognized, was it refurbishing or an expansion? In order to familiarize, refurbishment has it been extended and the smaller warehouse. Yes, so great. It's the same sort of argument. It's the same question. That first part over here really links with this. So we've answered that. Good. So it's really about how we handle the disposal. And of course, again, in terms of, you say here, check to see. Yes, I like the word inspect. It's much stronger. And of course, you correct. You say recalculate the profit on the sale. Good. And that's kind of where we're going. We'll look at the answers and see. Our aim is to line up as close to the mark scheme as possible. So 1 and 1. Brilliant. 1.5 million borrowed from the bank. So anyway, let's talk about what you've written. There's a risk that the loan has not been correct, and that's enough. That's enough for a 1. Check the bank to review the loan has been split. Yes. So and yeah, so you've said check the bank that the loan was received, fair enough, and review that the loan has been split correctly. So yes, and I think that's the key point here, and also has been disclosed, and we have that disclosure. We also have to see a clear disclosure. So I've written here, inspect the bank letter, just because when you say check the bank, I know what you mean, but it's a bank letter. Right, and remember the bank letter has all the additional information, if you like, as to what assets will be held as collateral against that loan. So that's what you're really inspecting ultimately. Now, again, oh, sorry, you say that here. Sunflower may have secured the loan against some assets. Good, so ask for them to provide details. Perfect. It's actually here. It's like I can't read. And the terms of any covenants attached. Great. And we need to see a disclosure of all of these as well. Now, I write here, and you see this again. Every time you see a question about loans, there's the issue of the risk of a lack of disclosure of the security, number one. There's the question you've highlighted clearly, this poor classification, the failure to classify between current and non-current terms. And I've written every time you see a question with a loan, there is an extra bit, of course, it's coming, and this is the extra, very important bit, but you won't forget it now, is this discussion of interest. So you must always talk, they never give it to you, they never tell you, but you have to talk about interest. The fact here is that interest is calculated, it probably is accrued, so they have to, and it depends on the nature of the loan. So, you might be, as far as the bank is concerned, you might just be, some loans might just be capital repayments, but accounting requires us to accrue interest because there is a cost to the loan. So the accrual concept requires the calculation of interest, even though the nature of the arrangement of the loan might just look like purely repayment of capital. So key point here is discussion interest. So we need to recalculate it, inspect the journal in the income statement, and inspect if it has been paid. The next issue is this question of a loan breach, right? So the question is, if there therefore is a failure of interest, then it means that suddenly the loan might be called back for, or there might be a potential loss of security, or the loan will, all the non-current aspects of the loan will turn into current aspects and therefore should be recognized as such and disclosed as such. Right, good. So we'll see when we come to the answers, we'll see what they're talking about there. Right, good. So this is an interesting one. Here it says the finance director believes valuing this is close. So inventory should be valued, and that's IAS 2, and there is a risk that yes, inventory will be, if you like, overstated if the FD's approximation is unreasonable. Perfect. So let's go with that overstatement. We're quite clear that that's what's going on. When we go to the answers actually argue that that's selling price minus this average margin takes it to a figure that's lower than selling price. The question is this thing close enough to cost, which is what you ask here. Also, check or reperform or recalculate the selling price minus average and compare to the cost to see if his theory is correct. And I've written excellent because that's really the argument here. And it's about checking for reasonableness. Really good. And so, yeah, I think I gave you 8 out of 10 there. That was strong. That's strong. Let's look at the answers. So looking at the answers, what have they gone with? So they've gone with the following. They've said the sunflower 1.6, exactly what you said. They've said misstatement. That's fine, like you did. But I guess the question is if the expenditure has been treated incorrectly. We can go further. We can really go further and say that exactly what you were doing. If you've increased, if revenue has been put in capital, we can use the term overstatement. We can go further. Review a breakdown. They've said review. That's good actually. That's interesting. I'd have gone with inspect, but that's it. Review a breakdown. That's great. And if the agreed to the statement of profit or loss, basically inspect the thing and make sure capital is capitalized and revenue is put through as an expense. Right. Good. Dispose as a profit. Again, we highlight the fact that it's probably not been removed. Profit and therefore profit is not understated, if you like, or if it's not been calculated correctly, if you like. And this is an I completely forgot this one. The fact is that, well, to be honest, we typically, well, if it's a company, we might include profit on disposal, put it with some other income, but maybe it's enough to put it on its own. But the key point here is, which you mentioned, is the fact that it's been removed, right? And recalculate the profit on disposal. Recalculate those A, E, I, O, U are the procedures we follow, but that's fine. Great. Let's look at the next one. Sunflower borrowed this, like you said, correctly split it. Disclosure, if it's not classified. Confirm, and the split and the disclosure. So we can see there everything we just finished talking about. Again, you talk about this fact about giving it a charge. Disclosure, important. Disclosure. We must disclose of any security. And yes, of course. This is the loan agreement should be reviewed and circularized as part of the bank confirmation process. So you asked requesting the bank letter. Same thing there. And Sunflower may be undertaking a number of, well, they only wanted 5. So inventory was an important one. There's a risk here that you won't be able to attend. We need to go with what's rational here. We need to go with the ones that are material, if you like, and that's where we're really going. So inspect a sample, and then that's what we want to sort of do. But the risk is that you won't be able to. The risk is a threat to value to completeness because you're not there to observe the actual inventory. So, do you how can you be sure that all the evidence is complete and exists if you can't attend? So that's a risk, but you can manage it by looking for the material areas. Right. Again, of course, there's the kind of IAS 2. Inventory should be valued, and I think you talk about this. Yes, the fact that we don't know. You see, testing should. because we don't know, this guy is telling us, so we need to actually almost recalculate to make sure that selling price minus this average margin business is actually close enough to cost. Um, and that's what we're trying to highlight, that it says as long as and you say that as long as it's a close approximation to cost. So we're going to have to do some recalculation anyway. I think, of course, some after-date testing where you actually look to see what it's sold for will tell you whether or not, but that's not really our issue. Our issue is whether this selling price minus average profit margin is actually close enough to cost is our issue. Right, again, the opening balances. So this is a good one. Opening balances may have not been completely, it's about completeness, isn't it? So we actually want to inspect the actual process of transfer. We want to inspect the actual transfers. And there's a risk that the opening balances may be misstated, or there might be errors, because as you can imagine, so what we're really trying to understand is the journals that have of the transfer process, really. How have you transferred that data? Because we want to make sure it's complete and accurate. They're opening balances, you know. So they give you some options here. I think you were okay with the first. If you highlight this, I mean, cats are used generally for testing, but it was enough. And finally, they said someone left, so there's an error again. Potential risk of mistakes because the finance controller has left, and the new one might not be experienced. So it's really about professional skepticism and being aware of potential errors. Right, good. So let's look at your answer on internal audit, which I think I must have done after you did this paper. But again, I liked your answers. They were all very strong. Cost versus benefit. I think consider whether, yeah, so we talked about the complexity of the firm. What is there in terms of it can act as a deterrent, the culture in the place. Consider where the IA may give the shareholders more confidence. Yes, positive steps to managing controls, detecting fraud risks. So all very strong answers. Whether there's already, so where they need to know, are they going to have to bring someone in? Do they have staff in place? If you like. So let's look at their answers and kind of highlighting kind of the big points, the cost, size and complexity. So the larger, if you like, the more the bigger the organization, right? And I think I mentioned and talked about the different. If you have big organizations with big functional areas, it does make sense to have a separate internal audit function. The question is, we have to ask questions: the degree of independence. Will they be able to answer to an audit committee, for example? So the role of the IA department should be considered. The finance director should consider whether the tasks, inventory counts. Remember, we talked about internal audits has been able to do a range of tasks. Can people do it? So yeah, some very good work. Current situation and fraud. And how much do the senior managers want assurance on this? So a range of very good answers. So I thought this was a good question. Well done. We'll move on to the next question.